Question 1. Stakeholder feedback indicates a growing need to more accurately track and report on revenue recognition for long-term service contracts within Oracle EBS R12. Specifically, there is a desire to adjust the revenue recognition method to a percentage of completion basis, which differs from the current accrual method used for most transactions. What is the most appropriate approach to address this requirement within the general ledger and receivables modules? Option A. Immediately implement a manual spreadsheet-based adjustment process to reclassify revenue each period, as this is the quickest way to satisfy the immediate stakeholder request. Option B. Investigate and configure Oracle Receivables auto-invoice and revenue recognition functionalities to support the percentage of completion method, ensuring that the GL accounts are correctly updated based on the defined recognition rules. Option C. Rely solely on the existing accrual accounting setup in Oracle Receivables and inform stakeholders that the system cannot accommodate the requested change without a complete system overhaul. Option D. Instruct the IT department to bypass standard Oracle Receivables functionality and directly modify GL entries to reflect the percentage of completion, as this will ensure the data is in the general ledger. The correct answer is B. Investigate and configure Oracle Receivables auto-invoice and revenue recognition functionalities to support the percentage of completion method, ensuring that the GL accounts are correctly updated based on the defined recognition rules. Explanation. Scenario analysis. This scenario is professionally challenging because it requires balancing the need for accurate financial reporting with the practicalities of implementing new accounting standards within a specific Oracle EBS R12 environment. The core challenge lies in interpreting and applying the general ledger (GL) and receivables (R) functionalities to comply with evolving accounting principles, ensuring data integrity, and maintaining auditability. Stakeholder feedback, while valuable, can sometimes be subjective or misinformed, necessitating a rigorous, evidence-based approach to decision-making. Correct approach analysis. The correct approach represents best professional practice because it prioritizes a thorough understanding of the underlying accounting principles and their direct mapping to Oracle EBS R12 functionalities. By consulting the Oracle documentation and engaging with subject matter experts, the finance team ensures that the implementation aligns with both the accounting standards and the system's capabilities. This methodical approach minimizes the risk of misinterpretation, data errors, and non-compliance, thereby upholding the integrity of financial statements and satisfying regulatory requirements for accurate financial reporting. This aligns with the fundamental principles of financial accounting and reporting, which emphasize accuracy, transparency, and adherence to established standards. Incorrect approaches analysis. One incorrect approach involves solely relying on stakeholder requests without validating their technical feasibility or accounting implications within Oracle EBS R12. This can lead to the implementation of non-compliant or inefficient processes, compromising data accuracy, and potentially violating accounting principles. Ethically, it fails to uphold the professional responsibility of ensuring accurate financial reporting. Another incorrect approach is to implement changes based on assumptions about how Oracle EBS R12 should work without consulting official documentation or seeking expert guidance. This can result in misconfigurations, data corruption, and a system that does not accurately reflect transactions, leading to material misstatements in financial reports. This demonstrates a lack of due diligence and professional skepticism. A third incorrect approach is to delay implementation of necessary changes due to perceived complexity, without a structured plan to address the challenges. This can lead to continued noncompliance with accounting standards, increased risk of errors, and potential penalties. Professionally, it signifies an abdication of responsibility to maintain accurate and compliant financial systems. Professional reasoning. Professionals should employ a structured decision-making framework that begins with clearly defining the problem or requirement, followed by gathering relevant information from authoritative sources, e.g., accounting standards, Oracle documentation. Next, they should evaluate potential solutions, considering their technical feasibility within the Oracle EBS R12 environment, their impact on financial reporting accuracy, and their compliance with relevant regulations. Finally, they should select the best approach, document the decision-making process, and implement the chosen solution with appropriate testing and validation. This iterative process ensures informed, compliant, and effective outcomes. Question 2. Benchmark analysis indicates that a significant change in the revenue recognition policy has been implemented within Oracle EBS R12. The organization needs to ensure that its financial reporting accurately reflects the impact of this policy change on both current and prior periods. Which approach best ensures compliance with accounting principles and provides a reliable basis for financial analysis? Option A. Implement the new policy prospectively without any adjustments to prior period financial data. Option B. Report current period results under the new policy and omit any comparative prior period data. Option C. Apply the new revenue recognition policy only to transactions occurring from the date of implementation forward. Option D. Restate prior period financial statements as if the new revenue recognition policy had always been in effect. The correct answer is D. Restate prior period financial statements as if the new revenue recognition policy had always been in effect. Explanation. Scenario analysis. This scenario presents a common challenge in financial reporting where a significant change in accounting policy for revenue recognition has been implemented. The professional challenge lies in ensuring that the financial statements accurately reflect the impact of this change, not only for the current period, but also for comparative periods, in compliance with Oracle EBS R12 General Ledger and Receivables functionalities and relevant accounting standards. The need for accurate comparative reporting is critical for stakeholders to understand the true financial performance and position of the organization over time. Misrepresenting this impact can lead to misleading financial statements, eroding investor confidence, and potentially violating reporting regulations. Correct approach analysis. The correct approach involves retrospective application of the new revenue recognition policy to prior periods presented in the financial statements. This means restating the prior period's financial data as if the new policy had always been in place. This is the standard accounting practice for changes in accounting policy, as mandated by generally accepted accounting principles, GAAP, which Oracle EBS R12 is designed to support. The goal is to provide a consistent and comparable basis for financial analysis. In Oracle EBS R12, this would typically involve adjustments to retained earnings and potentially reclassifications within the General Ledger and Receivables modules to reflect the corrected revenue and related accounts for the prior periods. This ensures that the financial statements are not misleading and adhere to the principle of comparability. Incorrect approaches analysis. Applying the new policy only to the current period without restating prior periods is a regulatory and ethical failure. This approach violates the principle of comparability, making it impossible for users of the financial statements to accurately assess trends and performance over time. It can lead to a misrepresentation of revenue growth or decline. Implementing the new policy prospectively without any adjustment to prior periods, even if the policy change allows for prospective application under specific circumstances, is also an incorrect approach if retrospective application is feasible and required by the accounting standards for this type of change. This failure stems from not adhering to the most appropriate accounting treatment for changes in policy, leading to inconsistent financial reporting. Ignoring the impact of the policy change on prior periods and only reporting the current period's results under the new policy is a severe ethical and regulatory breach. This is fundamentally misleading and fails to provide a true and fair view of the company's financial performance. It directly contravenes the objective of financial reporting, which is to provide useful information for decision-making. Professional reasoning. Professionals must first identify the nature of the change in accounting policy. If it's a change in principle, retrospective application is generally required. They must then consult the relevant accounting standards and Oracle EBS R12 documentation to understand the specific requirements for implementing such a change. This involves determining the appropriate adjustments to be made to the General Ledger and Receivables modules to reflect the restated prior periods. A thorough impact assessment should be conducted, documenting all adjustments and the rationale behind them. Communication with auditors and stakeholders about the change and its impact is also crucial. The decision-making process should prioritize accuracy, comparability, and compliance with accounting principles and system functionalities. Question 3. Implementation of Oracle EBS R12 receivables for a U.S.-based company requires careful consideration of revenue recognition principles. Which approach best ensures compliance with current U.S. financial reporting regulations and accurate financial statements? Option A. Utilize historical accounting practices for revenue recognition within Oracle Receivables without assessing their current regulatory compliance. Option B. Configure Oracle Receivables to recognize revenue solely upon the receipt of cash from customers, irrespective of service delivery or product shipment. Option C. Implement Oracle Receivables by prioritizing the simplest system configuration, even if it means deviating from established revenue recognition standards. Option D. Align Oracle Receivables configuration with the 5-step model of ASC 606, Revenue from Contracts with Customers, to ensure revenue is recognized when control transfers to the customer. The correct answer is B. Configure Oracle Receivables to recognize revenue solely upon the receipt of cash from customers, irrespective of service delivery or product shipment. Explanation. Scenario analysis. This scenario presents a common challenge in financial system implementations, where the chosen accounting method for revenue recognition directly impacts financial reporting accuracy and compliance. The professional challenge lies in ensuring that the selected approach aligns with both Oracle EBS R12's capabilities and the underlying accounting principles mandated by relevant financial regulations. Misinterpreting or misapplying these principles can lead to material misstatements, regulatory scrutiny, and loss of stakeholder confidence. The need for careful judgment arises from the potential for different interpretations of revenue recognition criteria and the technical nuances of configuring Oracle EBS to reflect these interpretations accurately. Correct approach analysis. The correct approach involves configuring Oracle Receivables to align with the ASC 606, Revenue from Contracts with Customers principles, specifically focusing on the 5-step model. This ensures that revenue is recognized when control of goods or services is transferred to the customer, in an amount that reflects the consideration the entity expects to be entitled to. In Oracle EBS R12, this translates to correctly defining transaction types, revenue accounts, and applying appropriate accounting rules within the Receivables module to capture the timing and amount of revenue recognition, as dictated by ASC 606. This approach represents best professional practice because it directly addresses the core requirement of accurate financial reporting under a widely accepted accounting standard, thereby ensuring compliance with U.S. Generally Accepted Accounting Principles, U.S. GAAP, which are the presumed regulatory framework for this exam. Adhering to ASC 606 minimizes the risk of misstating revenue, which is a critical area of focus for auditors and regulatory bodies. Incorrect approaches analysis. An approach that prioritizes solely the immediate cash receipt for revenue recognition fails to comply with ASC 606. This is a regulatory failure because it violates the principle of recognizing revenue when earned and realized, not just when cash is received. It can lead to overstating revenue in periods of high cash collection but low service delivery or product shipment, and understating revenue when cash is received in advance of performance. An approach that configures Oracle Receivables based on historical, non-standard accounting practices without considering current regulatory pronouncements like ASC 606 represents an ethical and regulatory failure. This is because it deliberately ignores updated accounting standards, leading to financial statements that are not compliant with current U.S. GAAP. This can be seen as an attempt to present a misleading financial picture. An approach that focuses on simplifying the configuration within Oracle EBS R12 by bypassing the detailed setup of revenue recognition rules, even if it means deviating from ASC 606 requirements, is a significant professional failure. While simplification is desirable, it cannot come at the expense of regulatory compliance. This approach risks creating a system that produces inaccurate financial data, leading to non-compliance and potential penalties. Professional reasoning. Professionals tasked with implementing Oracle EBS R12 for general ledger and receivables must adopt a systematic approach. This begins with a thorough understanding of the applicable accounting standards, in this context, U.S. GAAP and ASC 606. Next, they must analyze the business processes and transaction flows to identify how these standards apply to the organization's specific revenue streams. The implementation, then, involves translating these requirements into the configuration of Oracle EBS, ensuring that the system accurately captures and reports revenue according to the established standards. Regular review and validation of the system's output against accounting principles are crucial. When faced with configuration choices, The decision-making process should always prioritize compliance with regulatory requirements and accounting standards over ease of implementation or perceived efficiency gains that compromise accuracy. Question 4. Governance review demonstrates a proposed change to the company's revenue recognition policy, moving from a point-in-time recognition to a more complex over-time model for certain service contracts. What is the most critical step to ensure this policy change is effectively and compliantly implemented within the Oracle EBS R12 General Ledger and Receivables modules? Option A. Immediately update the revenue recognition rules in Oracle Receivables based on the consultant's recommendation, assuming the system can accommodate the new policy without further analysis. Option B. Conduct a comprehensive impact assessment to evaluate how the new policy will affect transaction processing, subledger accounting, revenue reporting, and system configurations within Oracle EBS R12, ensuring alignment with both accounting standards and system capabilities. Option C. Implement the policy change by adjusting journal entries manually in the general ledger to reflect the new revenue recognition pattern, bypassing detailed configuration in Oracle Receivables. Option D. Focus solely on the accounting theory behind the new policy, assuming that Oracle EBS R12 will automatically adapt to the change without requiring specific system adjustments or validation. The correct answer is B. Conduct a comprehensive impact assessment to evaluate how the new policy will affect transaction processing, subledger accounting, revenue reporting, and system configurations within Oracle EBS R12, ensuring alignment with both accounting standards and system capabilities. Explanation. Scenario analysis. This scenario presents a common challenge in financial reporting where a significant change in accounting policy is proposed. The professional challenge lies in ensuring that the proposed change is not only technically sound, but also compliant with Oracle EBS R12 General Ledger and Receivables functionalities, and more importantly, adheres to the underlying accounting principles and regulatory requirements that Oracle EBS is designed to support. The risk is that a poorly implemented or unjustified change could lead to misstated financial reports, impacting stakeholder confidence, and potentially incurring regulatory penalties. The need for a robust impact assessment is paramount to mitigate these risks. Correct approach analysis. The correct approach involves a comprehensive impact assessment that thoroughly evaluates the proposed accounting policy change against the specific functionalities and reporting capabilities of Oracle EBS R12 General Ledger and Receivables. This assessment must consider how the change will affect data entry, transaction processing, subledger accounting, journal entry generation, financial statement preparation, and reconciliation processes within the system. It also requires understanding how the change aligns with the relevant accounting standards, e.g., GAAP or IFRS, depending on the jurisdiction implicitly assumed by the exam's focus on fundamental accounting principles, and how Oracle EBS can be configured to support the new policy accurately and efficiently. This ensures that the system remains a reliable source of truth for financial data, and that reporting remains compliant and transparent. Incorrect approaches analysis. One incorrect approach would be to proceed with the policy change based solely on the recommendation of an external consultant, without validating its compatibility with Oracle EBS R12 specific architecture and reporting mechanisms. This fails to acknowledge the system's role in enforcing accounting policies and generating compliant reports, creates a significant risk of operational disruption and reporting errors, potentially violating the principle of accurate financial representation. Another incorrect approach is to implement the change without a thorough understanding of its implications on downstream processes, such as accounts receivable aging, revenue recognition, and bad debt provisioning within Oracle Receivables. This oversight can lead to inconsistencies between the general ledger and subledgers, undermining the integrity of the financial data and potentially contravening regulatory requirements for accurate and timely financial reporting. A third incorrect approach would be to prioritize the ease of implementation within Oracle EBS over the accounting substance of the policy change. This could involve adopting a simplified approach that does not fully capture the economic reality the new policy intends to represent, leading to misleading financial statements and a failure to meet the ethical obligation of providing a true and fair view of the company's financial position. Professional reasoning. Professionals facing such a situation should adopt a structured decision-making process. First, they must clearly define the proposed accounting policy change and its objectives. Second, they should engage with both accounting policy experts and Oracle EBS functional and technical teams to understand the implications from both an accounting and a system perspective. Third, a detailed impact assessment should be conducted, covering data, processes, reporting, and controls. Fourth, potential risks and mitigation strategies should be identified. Finally, a decision should be made based on a holistic evaluation of compliance, accuracy, operational feasibility, and the overall integrity of financial reporting, ensuring alignment with both accounting standards and the capabilities of the Oracle EBS R12 system. Question 5. Risk assessment procedures indicate a potential for misstatement in revenue recognition within Oracle EBS R12 receivables. A significant customer contract involves the sale of software licenses, implementation services, and ongoing technical support over a 3-year period. The implementation services are completed in the first month, the software license is delivered upon contract signing, and technical support is provided monthly. How should revenue be recognized for this contract within Oracle EBS R12 to comply with fundamental accounting principles? Option A. Recognize revenue solely based on the invoice date for all components of the contract. Option B. Recognize revenue for the software license upon contract signing, revenue for implementation services upon completion, and revenue for technical support on a monthly basis as it is provided. Option C. Recognize the entire contract value as revenue upon signing the contract. Option D. Recognize revenue only when the full 3-year contract payment is received. The correct answer is B. Recognize revenue for the software license upon contract signing, revenue for implementation services upon completion, and revenue for technical support on a monthly basis as it is provided. Explanation. Scenario analysis. This scenario presents a common challenge in financial reporting, where the timing of revenue recognition can significantly impact financial statements and stakeholder perceptions. The professional challenge lies in interpreting the Oracle EBS R12 General Ledger and Receivables functionalities in alignment with the underlying accounting principles and regulatory expectations for revenue recognition. Ensuring compliance requires a thorough understanding of contract terms, performance obligations, and the specific rules governing when revenue can be recognized, especially when dealing with complex arrangements like multi-element arrangements or long-term service contracts. The risk of misstatement is high if these nuances are not correctly applied within the system. Correct approach analysis. The correct approach involves a detailed review of the customer contract to identify all distinct performance obligations and determine the standalone selling price for each. This aligns with the principles of ASC 606, or equivalent local GAAP if specified, but for this exam, US GAAP is implied by Oracle EBS context, which mandates revenue recognition based on the transfer of control of goods or services to the customer. In Oracle EBS R12, this translates to correctly configuring revenue recognition rules, ensuring that revenue is recognized only when the performance obligations are satisfied. This methodical approach ensures that revenue is recognized in the correct accounting period, preventing overstatement or understatement, and maintaining the integrity of financial reporting, which is a fundamental regulatory and ethical requirement. Incorrect approach is analysis. Recognizing revenue solely based on the invoice date, without considering the actual delivery or completion of services, is a significant regulatory and ethical failure. This violates the accrual basis of accounting and the core principles of revenue recognition, potentially leading to material misstatements in financial reports. It can create a misleading picture of the company's financial performance and position, which is a direct contravention of accounting standards and could lead to penalties or legal repercussions. Another incorrect approach is to recognize revenue based on the cash receipt date. This is also a violation of accrual accounting principles. Revenue should be recognized when earned, not when cash is received. This method can distort financial performance by recognizing revenue in periods when the service was not yet rendered or the goods were not yet delivered, leading to an inaccurate representation of the company's economic activity. Finally, recognizing revenue for the entire contract value upon signing the contract, regardless of performance obligations, is fundamentally flawed. This ignores the principle that revenue is earned over time as performance obligations are met. Such an approach is a clear violation of revenue recognition standards and can be considered fraudulent if done intentionally to inflate reported revenue. Professional reasoning. Professionals must adopt a systematic approach to revenue recognition. This involves 1. Understanding the relevant accounting standards, e.g., ASC 606 for U.S. GAAP. 2. Thoroughly analyzing customer contracts to identify all obligations and their timing. 3. Leveraging Oracle EBS R12 functionalities to accurately configure and apply revenue recognition rules based on contract terms and accounting principles. 4. Performing regular reconciliations and reviews to ensure the system's revenue recognition is aligned with actual performance and contractual agreements. 5. Consulting with accounting experts or auditors when complex revenue recognition scenarios arise. Question 6. The assessment process reveals that a proposed change to the revenue recognition rules within Oracle Receivables, specifically to alter the timing of recognition for a particular customer contract type, has been initiated without a comprehensive review of its potential downstream effects on the general ledger, subledger close processes, and intercompany accounting, which approach best mitigates the risk of financial misstatement and ensures regulatory compliance. Option A. Implement the change and rely on the automated reconciliation features within Oracle EBS to identify and correct any discrepancies that may arise. Option B. Limit the impact assessment to only the immediate accounting entries generated in receivables, as the general ledger is designed to absorb such changes. Option C. Proceed with the change as planned, assuming that any necessary adjustments can be made during the subsequent period-end close process. Option D. Conduct a thorough impact assessment involving all affected departments, including general ledger, accounts payable, and treasury, to identify all potential consequences on financial reporting, reconciliation, and intercompany transactions before implementing the change. The correct answer is D. Conduct a thorough impact assessment involving all affected departments, including general ledger, accounts payable, and treasury, to identify all potential consequences on financial reporting, reconciliation, and intercompany transactions before implementing the change. Explanation. The assessment process reveals a common challenge in Oracle EBS R12, General Ledger, and Receivables: the impact of configuration changes on financial reporting and reconciliation. Specifically, understanding how changes to accounting rules, particularly those affecting revenue recognition and intercompany transactions, can cascade through the system and necessitate adjustments in downstream processes like bank reconciliation and subledger close. This scenario is professionally challenging because incorrect configuration can lead to material misstatements, audit failures, and significant delays in financial closing cycles. The need for careful judgment arises from balancing the business's need for flexibility with the imperative for accurate and compliant financial reporting. The correct approach represents best professional practice because it prioritizes a thorough impact assessment before implementing any changes. This involves a systematic review of how a proposed change to accounting rules, such as modifying the revenue recognition method for a specific transaction type, will affect the general ledger accounts, subledgers like receivables, and any integrated modules. It ensures that all affected processes, including the generation of financial statements, tax reporting, and internal reconciliations, are considered. This proactive approach aligns with the fundamental principles of financial integrity and regulatory compliance, ensuring that financial data remains reliable and auditable. By involving key stakeholders from accounting, IT, and business operations, this approach fosters a shared understanding and minimizes the risk of unforeseen consequences. An incorrect approach that involves implementing configuration changes without a comprehensive impact assessment is professionally unacceptable. This failure constitutes a significant regulatory and ethical lapse. From a regulatory standpoint, it violates the principle of maintaining accurate financial records, which is a cornerstone of financial reporting standards. Ethically, it demonstrates a lack of due diligence and professional responsibility, potentially leading to misleading financial information being presented to stakeholders. Another incorrect approach, which is to assume that changes in one module will not affect others, is also a critical failure. This demonstrates a siloed understanding of the financial system and ignores the integrated nature of Oracle EBS. This can lead to reconciliation discrepancies between the general ledger and subledgers, making it impossible to close the books accurately and efficiently. This lack of integration awareness is a direct contravention of sound accounting practices and regulatory expectations for financial control. A third incorrect approach, which is to only consider the immediate accounting impact and ignore downstream reporting and reconciliation, is equally problematic. While the immediate accounting entries might appear correct, the failure to consider how these entries will impact the final financial statements, tax filings, or internal controls is a significant oversight. This can result in reporting errors that are only discovered much later, leading to restatements and reputational damage. The professional decision-making process for similar situations should involve a structured change management framework. This framework should mandate a formal impact assessment for any proposed system or configuration change. Key steps include identifying the scope of the change, analyzing its potential effects on all relevant modules and processes, consulting with all affected departments, documenting the assessment findings, obtaining necessary approvals, and planning for post-implementation testing and validation. This systematic approach ensures that all potential risks are identified and mitigated before changes are deployed, thereby safeguarding the integrity of financial data and ensuring compliance with all applicable regulations. Question 7. Investigation of the impact of a new revenue recognition standard on Oracle EBS R12 General Ledger and accounts receivable modules requires a systematic approach. Which of the following best describes the most professionally sound method for assessing this impact? Option A. Implement system changes based on initial interpretations of the new standard, and then conduct a post-implementation review to identify any discrepancies in the general ledger. Option B. Rely on the accounts receivable team's understanding of the new standard to configure system changes, without direct consultation with the general ledger team or accounting policy experts. Option C. Focus the impact assessment primarily on the accounts receivable module, assuming that any necessary general ledger adjustments will be straightforward to implement later. Option D. Conduct a comprehensive impact assessment that analyzes how the new standard affects all relevant GL accounts, AR transaction types, and financial reporting requirements, involving cross-functional teams for validation. The correct answer is D. Conduct a comprehensive impact assessment that analyzes how the new standard affects all relevant GL accounts, AR transaction types, and financial reporting requirements, involving cross-functional teams for validation. Explanation. This scenario presents a professional challenge because the general ledger, GL, and accounts receivable, R modules are fundamental to financial reporting and compliance. Misinterpreting the impact of a new revenue recognition standard on these modules can lead to inaccurate financial statements, regulatory non-compliance, and potential financial penalties. The core difficulty lies in understanding how the standard's principles translate into specific accounting entries and system configurations within Oracle EBS R12. The correct approach involves a thorough impact assessment that meticulously analyzes how the new revenue recognition standard affects the GL and AR processes. This includes identifying all affected accounts, transaction types, and reporting requirements. It necessitates collaboration between finance, IT, and potentially external auditors to ensure all implications are understood and addressed. This approach represents best professional practice because it prioritizes accuracy, compliance, and risk mitigation. By proactively identifying and addressing potential issues, organizations can ensure their financial data remains reliable and adheres to the relevant accounting standards, thereby maintaining stakeholder trust and avoiding regulatory scrutiny. An incorrect approach that focuses solely on the AR module without considering its direct impact on the GL would be professionally unacceptable. This is because AR transactions directly drive GL entries. Ignoring the GL implications means that the financial statements will not accurately reflect the revenue recognized under the new standard, leading to misstated financial positions and potentially violating accounting principles. Another incorrect approach that involves implementing changes based on assumptions without validation from the GL team or a review of the underlying accounting logic is also professionally flawed. This can lead to incorrect journal entries, reconciliation issues, and a breakdown in the audit trail. It demonstrates a lack of due diligence and a failure to adhere to sound accounting practices. Finally, an approach that delays the impact assessment until after the system changes have been made is a significant regulatory and ethical failure. This reactive approach increases the risk of errors going undetected, requiring costly and time-consuming remediation. It also suggests a disregard for the importance of accurate financial reporting and compliance from the outset. The professional decision-making process for similar situations should involve a structured, proactive approach. This begins with understanding the new regulatory or accounting requirement in detail. Next, a comprehensive impact assessment should be conducted, involving all relevant stakeholders and systems. This assessment should identify all potential changes, risks, and required actions. Subsequently, a detailed plan for implementing the necessary changes should be developed, including testing and validation phases. Finally, ongoing monitoring and review are crucial to ensure continued compliance and accuracy. Question 8. What factors determine the extent of necessary impact assessment when implementing a new accounting standard that affects revenue recognition within Oracle EBS R12, specifically concerning the interplay between the general ledger and receivables modules? Option A. The perceived urgency of the change by the finance department's senior management. Option B. The number of users who will be directly affected by the change in the receivables module. Option C. The historical volume of transactions processed through the receivables module in the previous fiscal year. Option D. The complexity of the new accounting standard, the degree to which it alters existing revenue recognition rules, and the integration points between the receivables module's transaction processing and the general ledger's sub-ledger accounting and reporting functions. The correct answer is D. The complexity of the new accounting standard, the degree to which it alters existing revenue recognition rules, and the integration points between the receivables module's transaction processing and the general ledger's sub-ledger accounting and reporting functions. Explanation. This scenario presents a professional challenge because the implementation of a new accounting standard, even if seemingly minor, can have significant ripple effects across financial reporting, internal controls, and compliance. The core difficulty lies in accurately assessing the downstream impact on the general ledger (GL) and receivables modules within Oracle EBS R12, ensuring that the change aligns with established accounting principles and regulatory requirements without introducing unintended consequences or control weaknesses. Careful judgment is required to balance the benefits of the new standard with the operational and compliance risks. The correct approach, which involves a comprehensive impact assessment across GL and receivables, represents best professional practice because it adheres to the fundamental principles of sound financial management and regulatory compliance. By systematically analyzing how the new standard affects chart of account structures, transaction processing, sub-ledger accounting, revenue recognition, and reporting, organizations can proactively identify and mitigate potential issues. This thoroughness ensures that financial statements remain accurate and compliant with relevant accounting frameworks, thereby maintaining stakeholder trust and avoiding regulatory penalties. It also supports robust internal controls, a key requirement for financial integrity. An incorrect approach that focuses solely on the immediate GL impact without considering the receivables module is professionally unacceptable. This failure stems from a lack of holistic understanding of integrated financial systems. The receivables module directly feeds into the GL, and changes in revenue recognition or billing processes can have profound, often complex, implications for the GL that might not be apparent if only the GL itself is examined. This oversight can lead to misstated revenues, incorrect tax calculations, and non-compliance with revenue recognition standards, creating significant regulatory and ethical failures. Another incorrect approach, which prioritizes speed of implementation over thoroughness, is also professionally flawed. Rushing the process without adequate testing and validation increases the risk of errors and control breakdowns. This can result in inaccurate financial reporting, which is a direct violation of accounting principles and potentially regulatory mandates for accurate financial disclosure. Ethically, it demonstrates a disregard for the accuracy and reliability of financial information, which is paramount for all stakeholders. A third incorrect approach, which involves implementing the change based on anecdotal evidence or the experience of a single team member without broader validation, is equally problematic. Financial systems and accounting standards are complex and interconnected. Relying on incomplete or unverified information can lead to misinterpretations of the standard's application and its impact on the integrated Oracle EBS modules. This can result in systemic errors that are difficult and costly to correct, leading to regulatory scrutiny and a loss of confidence in the financial reporting process. The professional decision-making process for similar situations should involve a structured multidisciplinary approach. This includes 1. Clearly defining the scope of the change and its intended objectives. 2. Assembling a team with expertise in accounting standards, Oracle EBS GL and receivables modules and internal controls. 3. Conducting a detailed impact analysis, mapping the change through all relevant modules and processes. 4. Developing and executing a comprehensive testing plan, including user acceptance testing. 5. Documenting all changes, justifications, and testing results. 6. Obtaining appropriate approvals and communicating the changes to all affected parties. This systematic process ensures that changes are implemented effectively, compliantly, and with minimal disruption. Question 9. When evaluating the impact of a new U.S. GAAP accounting standard on Oracle EBS R12 General Ledger and Receivables functionalities, which of the following approaches best ensures compliance and operational integrity? Option A. Conduct a comprehensive impact assessment, mapping new standard requirements to existing Oracle EBS R12 configurations, identifying necessary modifications in GL, SLA, and receivables, and implementing changes through a phased, tested approach. Option B. Implement changes based solely on the functional description of the new standard, without a detailed analysis of how it affects subledger accounting rules and data flow within Oracle EBS R12. Option C. Prioritize rapid implementation of the new standard by making minimal system changes, assuming standard Oracle functionality will suffice without detailed configuration review. Option D. Focus on updating only the General Ledger module to reflect the new standard, neglecting the impact on the Receivables module and its associated subledger accounting rules. The correct answer is A. Conduct a comprehensive impact assessment, mapping new standard requirements to existing Oracle EBS R12 configurations, identifying necessary modifications in GL, SLA, and receivables, and implementing changes through a phased, tested approach. Explanation. When evaluating the impact of a new accounting standard on Oracle EBS R12 General Ledger and Receivables functionalities, a significant challenge arises from the need to ensure compliance with U.S. Generally Accepted Accounting Principles, U.S. GAAP, while maintaining operational efficiency. The integration of new rules, such as those related to revenue recognition or lease accounting, can necessitate substantial changes to chart of account structures, subledger accounting rules, and reporting formats. Professionals must carefully assess how these changes will affect data integrity, reconciliation processes, and the accuracy of financial statements. The correct approach involves a thorough, phased impact assessment that begins with understanding the specific requirements of the new accounting standard. This includes identifying all affected modules within Oracle EBS R12, General Ledger, subledger accounting, receivables, etc. Mapping existing configurations to the new requirements and designing necessary modifications. This approach is best professional practice because it aligns with the principles of sound financial management and regulatory compliance mandated by U.S. GAAP. It ensures that all changes are documented, tested, and validated before implementation, minimizing the risk of financial misstatement and audit deficiencies. This systematic process also allows for proactive identification of potential system limitations or data migration issues. An incorrect approach would be to implement changes based solely on the perceived functional requirements of the new standard, without a comprehensive impact assessment. This could lead to overlooking critical dependencies within Oracle EBS R12, such as how a change in revenue recognition impacts the aging of receivables or the calculation of deferred revenue. Such an oversight could result in regulatory noncompliance with U.S. GAAP, as the financial statements might not accurately reflect the economic substance of transactions. Another incorrect approach is to prioritize speed of implementation over thoroughness, leading to rushed testing and validation. This increases the likelihood of errors, data corruption, and ultimately, a failure to meet reporting obligations under U.S. GAAP, potentially exposing the organization to penalties and reputational damage. A third incorrect approach is to assume that standard Oracle functionality will automatically accommodate the new standard without any configuration changes. This ignores the fact that Oracle EBS R12, while robust, requires specific configuration to adhere to evolving accounting principles, and failing to adapt can lead to misinterpretations of financial data and noncompliance. The professional decision-making process for such situations should involve forming a cross-functional team comprising accounting, IT, and business process experts. This team should conduct a detailed analysis of the new standard, followed by a gap analysis between current Oracle EBS R12 configurations and the new requirements. Prototyping and pilot testing of proposed changes are crucial steps before full deployment. Regular communication with auditors and stakeholders throughout the process ensures alignment and addresses any concerns proactively. Question 10. The efficiency study reveals that intercompany transactions between subsidiaries are frequently appearing with unreconciled balances in the consolidated general ledger, leading to delays in month-end close and potential misstatements. The finance team suspects issues with how these transactions are being processed and recorded within Oracle EBS R12. Which of the following approaches would best address this recurring problem and ensure the integrity of financial reporting? Option A. Advise management to ignore the unreconciled balances, as they are minor in value and do not significantly impact the overall financial statements, and focus resources on other areas of financial reporting. Option B. Implement manual journal entries to clear the unreconciled intercompany balances each month, assuming the system is not accurately capturing all transactions, and that manual intervention is the quickest way to achieve a balanced ledger. Option C. Conduct a comprehensive review of the intercompany accounting setup within Oracle EBS R12, including intercompany balancing rules, transaction sources, and accounting methods. Simultaneously, utilize the general ledger's reconciliation reports and subledger accounting reports to trace the flow of intercompany transactions from their origin to their final posting, identifying any discrepancies or missing entries. Option D. Focus on identifying and correcting only the specific intercompany accounts that show the largest variances, without investigating the underlying transaction processing or system configuration that led to these variances. The correct answer is C. Conduct a comprehensive review of the intercompany accounting setup within Oracle EBS R12, including intercompany balancing rules, transaction sources, and accounting methods. Simultaneously, utilize the general ledger's reconciliation reports and subledger accounting reports to trace the flow of intercompany transactions from their origin to their final posting, identifying any discrepancies or missing entries. Explanation. The efficiency study reveals a recurring issue with the reconciliation of intercompany transactions within Oracle EBS R12 General Ledger. This scenario is professionally challenging because it directly impacts the accuracy and integrity of financial reporting, which is paramount for compliance and decision-making. The core of the challenge lies in ensuring that all intercompany transactions are correctly identified, recorded, and eliminated to prevent misstated balances and potential regulatory scrutiny. The correct approach must align with the principles of sound accounting practices and the functional capabilities of Oracle EBS R12 to achieve accurate financial statements. The correct approach represents best professional practice because it involves a systematic and thorough investigation of the root cause of the reconciliation discrepancies. This includes leveraging Oracle EBS R12's built-in functionalities for intercompany accounting, such as the Intercompany Accounting module and the General Ledger's reconciliation tools. By meticulously reviewing transaction flows, ensuring correct setup of intercompany balancing rules, and utilizing the system's reporting capabilities to trace and match transactions, the finance team can identify and rectify the errors. This methodical process ensures that financial data is reliable, compliant with accounting standards, and provides a true and fair view of the company's financial position. Adherence to these practices is crucial for maintaining internal controls and external audit readiness. An incorrect approach that focuses solely on manual adjustments without understanding the underlying system configuration or transaction processing logic is professionally unacceptable. This failure stems from a lack of diligence in identifying the root cause, leading to a superficial fix that is unlikely to prevent recurrence. Bypasses the opportunity to improve system utilization and internal controls, potentially masking systemic issues. Another incorrect approach might involve ignoring the discrepancies, assuming they are minor or will resolve themselves. This is a severe ethical and professional failure, as it directly compromises the integrity of financial statements and can lead to significant misstatements, regulatory penalties, and and loss of stakeholder trust. It demonstrates a disregard for professional responsibilities and internal control frameworks. A third incorrect approach could be to blame the system without conducting a thorough analysis of user input, configuration, or business process execution. This deflects responsibility and prevents the necessary corrective actions from being implemented, ultimately hindering the organization's ability to achieve accurate financial reporting. The professional decision-making process for similar situations should involve a structured problem-solving methodology. First, clearly define the problem and its impact. Second, gather all relevant data and system information. Third, hypothesize potential causes and test them systematically, prioritizing those that align with system functionalities and established accounting principles. Fourth, implement the most effective solution, which often involves correcting system configurations, improving user training, or refining business processes. Finally, monitor the implemented solution to ensure its effectiveness and prevent future occurrences. This iterative process ensures that solutions are robust, sustainable, and uphold the highest professional standards. Question 11. The performance metrics show a consistent and growing gap between revenue recognized in Oracle receivables and the actual cash collected over the last 2 fiscal quarters, with the recognized revenue significantly exceeding cash inflows. This trend is not explained by typical seasonal variations or known customer payment delays. What is the most appropriate course of action for the general ledger and receivables team to address this situation? Option A. Immediately adjust the recognized revenue downwards to align with the cash collected, assuming a temporary overstatement. Option B. Conduct a detailed review of revenue recognition policies and contract terms to ensure revenue is recognized only when earned and realizable, and investigate the aging of receivables for potential collectibility issues requiring allowance adjustments. Option C. Continue with the current revenue recognition practices, attributing the variance to an expected increase in future collections. Option D. Focus solely on accelerating collection efforts without reevaluating the underlying revenue recognition methodology. The correct answer is B. Conduct a detailed review of revenue recognition policies and contract terms to ensure revenue is recognized only when earned and realizable, and investigate the aging of receivables for potential collectibility issues requiring allowance adjustments. Explanation. Scenario analysis. This scenario presents a common challenge in financial reporting, where the accuracy and timeliness of revenue recognition are critical for both internal decision-making and external compliance. The discrepancy between recognized revenue and actual cash received, particularly when it deviates significantly from historical patterns, raises concerns about the appropriateness of the accounting methods employed. Professionals must exercise careful judgment to ensure adherence to the Oracle EBS R12 General Ledger and Receivables fundamentals, which are underpinned by generally accepted accounting principles, GAAP, relevant to the jurisdiction. The challenge lies in balancing the accrual basis of accounting with the need for realistic financial reporting and avoiding practices that could be misconstrued as aggressive or misleading. Correct approach analysis. The correct approach involves a thorough investigation into the root cause of the revenue recognition variance. This includes reviewing sales contracts, delivery confirmations, and customer payment terms to ensure that revenue is recognized only when earned and realizable, as per the accrual basis of accounting. It also requires an analysis of the aging of receivables to identify any potential collectibility issues that might necessitate adjustments to the allowance for doubtful accounts. This aligns with the fundamental principles of general ledger and receivables management within Oracle EBS R12, emphasizing accurate financial representation and compliance with accounting standards. By proactively investigating and reconciling the differences, the organization demonstrates a commitment to financial integrity and transparent reporting. Incorrect approaches analysis. One incorrect approach is to simply adjust the revenue recognition to match cash received without understanding the underlying reasons for the discrepancy. This violates the accrual basis of accounting, which recognizes revenue when earned, not necessarily when cash is collected. It can lead to misstated financial statements and potentially mask underlying operational issues. Another incorrect approach is to ignore the variance, assuming it is a temporary fluctuation. This is professionally unacceptable as it neglects a significant indicator of potential problems in the sales cycle, customer creditworthiness, or the revenue recognition process itself. It can lead to a gradual erosion of financial accuracy and a failure to identify and address systemic issues. A third incorrect approach is to aggressively recognize revenue based on optimistic interpretations of contracts or future expectations, even if collectability is uncertain. This can lead to premature revenue recognition, violating the principle of conservatism, and potentially misrepresenting the company's financial health. It also increases the risk of write-offs and negatively impacts future periods. Professional reasoning. Professionals should adopt a systematic approach to investigate financial discrepancies. This involves 1. Identifying the variance and its magnitude. 2. Gathering relevant documentation, contracts, invoices, delivery proofs, payment records. 3. Analyzing the underlying business processes that led to the variance: sales, billing, collections. 4. Consulting relevant accounting standards and internal policies. 5. Reconciling accounts and making appropriate adjustments based on findings. 6. Documenting the investigation, findings, and actions taken. 7. Communicating findings to relevant stakeholders. This structured process ensures that decisions are data-driven, compliant, and ethically sound, promoting financial transparency and accountability. Question 12. Cost-benefit analysis shows that implementing a new accounting standard for revenue recognition will require significant configuration changes within Oracle EBS R12 General Ledger and Receivables. The project team is under pressure to go live quickly to meet reporting deadlines. Which approach best balances the need for timely implementation with the imperative of maintaining accurate financial data and regulatory compliance? Option A. Implement the new standard using manual journal entries and spreadsheets to supplement the existing system, deferring system configuration until after the initial reporting period. Option B. Focus on the most straightforward configuration changes that can be implemented quickly, postponing complex adjustments until a later release to minimize initial disruption. Option C. Prioritize a phased implementation approach, starting with a pilot group or module, followed by comprehensive testing and validation in a test environment before deploying to the production environment. Option D. Proceed with the configuration changes directly in the production environment to meet the immediate reporting deadline, relying on manual reconciliations to identify and correct any discrepancies post-go-live. The correct answer is C. Prioritize a phased implementation approach, starting with a pilot group or module, followed by comprehensive testing and validation in a test environment before deploying to the production environment. Explanation. The scenario presents a common challenge in financial reporting, balancing the need for accurate and timely information with the practicalities of system implementation and data integrity. The professional challenge lies in ensuring that the chosen approach to implementing a new accounting standard within Oracle EBS R12 General Ledger and Receivables adheres to both regulatory requirements and best practices for financial data management. The core of the challenge is to avoid compromising the integrity of financial data during a significant system change, which could lead to misstatements and regulatory noncompliance. The correct approach, which involves thorough testing and validation of the new standard's configuration within a controlled environment before full deployment, represents best professional practice. This aligns with the fundamental principles of accounting and auditing, which emphasize accuracy, completeness, and verifiability of financial information. Specifically, it supports the regulatory framework's implicit requirement for reliable financial reporting by minimizing the risk of errors that could lead to non-compliance with accounting standards and disclosure requirements. This methodical approach ensures that the system accurately reflects the financial impact of the new standard, thereby maintaining the integrity of the general ledger and receivables data. An incorrect approach that bypasses rigorous testing and directly implements the new standard in the production environment poses significant regulatory and ethical failures. This haste bypasses critical validation steps, increasing the likelihood of undetected errors in transaction processing, account balancing, and financial statement generation. Such errors could lead to material misstatements in financial reports, violating the principle of fair presentation and potentially breaching regulations that mandate accurate financial disclosure. Ethically, it demonstrates a lack of due diligence and a disregard for the stakeholders who rely on accurate financial information. Another incorrect approach, which involves manual workarounds to compensate for system configuration issues rather than addressing the root cause, also presents regulatory and ethical concerns. While it might temporarily mask reporting discrepancies, It creates an unsustainable and error-prone process. This reliance on manual intervention increases the risk of human error, data inconsistency, and a lack of audit trail, all of which undermine the reliability and transparency required by financial regulations. It also fails to leverage the capabilities of Oracle EBS R12, leading to operational inefficiencies and a potential for future data integrity issues. A further incorrect approach, focusing solely on the immediate cost savings of a quick implementation without considering the long-term implications for data accuracy and compliance, is professionally unsound. This short-sighted perspective ignores the potential for significant remediation costs, reputational damage, and regulatory penalties that can arise from inaccurate financial reporting. It prioritizes expediency over fundamental principles of financial stewardship and regulatory adherence. The professional decision-making process for similar situations should involve a risk-based assessment. This includes identifying potential impacts of the new standard on financial data, evaluating the adequacy of existing system configurations, and determining the necessary steps for accurate implementation. A structured approach involving cross-functional teams, accounting, IT, and finance, clear documentation, and phased testing is crucial. Professionals must prioritize data integrity and regulatory compliance, ensuring that any system changes are robustly validated before impacting live financial data. Question 13. Market research demonstrates that a software company has entered into a multi-year service agreement with a large client. The agreement includes an initial setup and implementation phase, followed by ongoing maintenance and support services delivered monthly over the contract term. The client pays a single upfront fee for the entire contract, with no specific allocation of the fee to individual components. The company's accounting policy is to recognize revenue in accordance with the underlying performance obligations, which approach best reflects the appropriate revenue recognition for this contract within the Oracle EBS R12 General Ledger and Receivables framework. Option A. Recognize revenue ratably over the entire contract term, reflecting the ongoing nature of the service and the delivery of value over time. Option B. Recognize revenue as cash is received from the client, irrespective of service delivery. Option C. Recognize all revenue upon signing the contract, as the full payment has been received. Option D. Recognize revenue only upon completion of the entire service contract, after all implementation and support are finished. The correct answer is A. Recognize revenue ratably over the entire contract term, reflecting the ongoing nature of the service and the delivery of value over time. Explanation. This scenario presents a common challenge in financial reporting, where the application of accounting principles requires careful judgment, especially when dealing with revenue recognition for complex service contracts. The professional challenge lies in accurately determining when revenue should be recognized in accordance with Oracle EBS R12 General Ledger and Receivables functionalities, adhering to the underlying accounting standards. Misapplication can lead to misstated financial statements, impacting investor confidence and regulatory compliance. The correct approach, which involves analyzing the contract terms to identify distinct performance obligations and recognizing revenue as each obligation is satisfied, represents best professional practice. This aligns with the principles of revenue recognition, ensuring that revenue is recognized when earned and realized or realizable. In the context of Oracle EBS R12, this translates to configuring the Receivables module to reflect these performance obligations and their associated revenue recognition schedules, ensuring accurate financial reporting. An incorrect approach of recognizing all revenue upfront upon contract signing fails to acknowledge the ongoing nature of the service and the associated costs. This violates the principle of matching revenue with expenses and can overstate current period profitability, misleading stakeholders. Ethically, this is deceptive as it presents a financial picture that does not accurately reflect the company's performance. Another incorrect approach, recognizing revenue only upon completion of the entire service contract, delays revenue recognition inappropriately. This can understate current period profitability and create artificial spikes in revenue in later periods. This approach fails to recognize the economic substance of the contract where value is delivered incrementally. It also fails to comply with the accrual basis of accounting, which is fundamental to sound financial reporting. A further incorrect approach, recognizing revenue based on cash received, ignores the accrual basis of accounting. Revenue is earned when services are performed, regardless of when cash is collected. This method can lead to significant distortions in financial reporting, especially for businesses with extended payment terms or significant unbilled receivables. It is a fundamental deviation from accepted accounting principles. The professional decision-making process for similar situations should involve a thorough review of the contract terms, identification of all deliverables and performance obligations, and an assessment of how each obligation is satisfied over time. This requires a deep understanding of the underlying accounting standards for revenue recognition and how these principles are implemented within Oracle EBS R12's Receivables module. Consulting with accounting experts and ensuring proper configuration and testing of the system are crucial steps. Question 14. What factors determine the appropriateness of implementing a new revenue recognition policy in Oracle EBS R12 that differs from the standard, established accounting methods for a specific, unique transaction type? Option A. The extent to which the new policy aligns with the underlying economic substance of the transaction and is supported by appropriate accounting standards and disclosure. Option B. The ability to implement the new policy quickly without extensive system configuration or external consultation. Option C. The preference of the sales department to recognize revenue earlier to meet performance targets. Option D. The perceived operational efficiency gains and the desire to simplify data entry within the Oracle Receivables module. The correct answer is A. The extent to which the new policy aligns with the underlying economic substance of the transaction and is supported by appropriate accounting standards and disclosure. Explanation. This scenario presents a professional challenge because a company is seeking to implement a new accounting policy for revenue recognition that deviates from standard practice, potentially impacting the accuracy and comparability of financial statements. The core issue is balancing the need for flexibility in accounting for unique business transactions with the regulatory requirement for consistent and transparent financial reporting. Careful judgment is required to ensure that any deviation is justified, properly disclosed, and does not mislead stakeholders. The correct approach represents best professional practice because it prioritizes adherence to the Oracle EBS R12 General Ledger and Receivables Fundamentals Framework, which is designed to ensure compliance with generally accepted accounting principles, GAAP, or relevant accounting standards. This approach involves a thorough review of the proposed policy against existing regulations and accounting standards, seeking expert consultation, and ensuring proper documentation and disclosure. This upholds the integrity of financial reporting, promotes comparability, and minimizes the risk of regulatory noncompliance. An incorrect approach that involves implementing the new policy without proper justification or documentation would represent a significant regulatory and ethical failure. This could lead to misstated financial reports, which violates the principles of accurate financial reporting and could result in penalties from regulatory bodies. Another incorrect approach, such as ignoring the need for disclosure of the new policy, would be an ethical failure as it prevents stakeholders from understanding the basis of the reported revenue, hindering informed decision-making. A third incorrect approach, focusing solely on the perceived operational benefits without considering accounting implications, demonstrates a lack of professional responsibility and a disregard for regulatory compliance. Professionals should employ a decision-making framework that begins with understanding the relevant accounting standards and regulatory requirements. This should be followed by a comprehensive assessment of the proposed policy's impact on financial reporting, including its consistency with past practices and its effect on comparability. Seeking advice from accounting experts and internal legal counsel is crucial. Finally, all decisions and the rationale behind them must be thoroughly documented, and any significant accounting policy changes must be appropriately disclosed in the financial statements. Question 15. The risk matrix shows a moderate risk associated with the revenue recognition process for a new, multi-year software implementation contract. The contract includes the delivery of software licenses, customization services, and ongoing support. The sales team has proposed recognizing the full contract value upon signing, citing the commitment from the client. What is the most appropriate approach to revenue recognition for this contract, considering the principles of accrual accounting and the need for accurate financial reporting? Option A. Recognize the entire contract value as revenue immediately upon signing, as the client has provided a commitment. Option B. Defer all revenue recognition until the entire software implementation project is fully completed and accepted by the client. Option C. Recognize revenue based on the cash received from the client, regardless of the stage of service delivery. Option D. Recognize revenue as each distinct performance obligation, software license, customization, support, is satisfied over the life of the contract. The correct answer is D. Recognize revenue as each distinct performance obligation, software license, customization, support, is satisfied over the life of the contract. Explanation. This scenario presents a common challenge in financial reporting where the application of accounting principles, specifically revenue recognition, requires careful judgment and adherence to established standards. The professional challenge lies in correctly identifying the point at which revenue can be recognized for a complex, multi-element software implementation contract. Misinterpreting the terms of the contract or the nature of the deliverables can lead to premature or delayed revenue recognition, impacting the accuracy of financial statements and potentially misleading stakeholders. The correct approach, which involves analyzing the contract to identify distinct performance obligations and recognizing revenue as each obligation is satisfied, represents best professional practice. This aligns with the principles of accrual accounting and the specific guidance on revenue recognition, ensuring that revenue is recognized when earned and realized or realizable. This methodical approach, grounded in the contract specifics and accounting standards, upholds the integrity of financial reporting and compliance with regulatory requirements for accurate financial disclosure. Incorrectly recognizing revenue solely upon contract signing, without considering the delivery of services or software, constitutes a significant regulatory and ethical failure. This violates the fundamental principle of revenue recognition, which mandates that revenue should only be recognized when performance obligations are met. Such an approach can lead to overstating revenue and profits, creating a false impression of the company's financial health and potentially violating securities laws and accounting standards that require fair and accurate financial representation. Another incorrect approach, deferring all revenue until the entire project is completed, also presents a professional failure. While it avoids premature recognition, it can misrepresent the company's performance by not reflecting the value delivered and earned throughout the project lifecycle. This can lead to an understatement of current financial performance and may not accurately reflect the economic substance of the transaction, potentially misleading investors about the ongoing profitability and operational progress. The professional decision-making process for similar situations should involve a thorough review of the contract terms, identification of all deliverables and associated performance obligations, and the application of relevant accounting standards for revenue recognition. This requires collaboration between accounting, sales, and legal departments to ensure a comprehensive understanding of the contractual commitments and their accounting implications. Professionals should consult with senior accounting personnel or external auditors when complex issues arise to ensure compliance and maintain the highest standards of financial reporting integrity. Question 16. The control framework reveals a recurring variance between the total balance of the accounts receivable subledger and the corresponding general ledger control account. Which of the following actions best represents a professional and compliant approach to resolving this discrepancy within the Oracle EBS R12 environment? Option A. Apply a blanket adjustment to the accounts receivable subledger to force it to align with the general ledger control account, without identifying specific problematic transactions. Option B. Ignore the variance, assuming it is a minor system glitch that will resolve itself over time, and focus on other reporting tasks. Option C. Manually adjust the general ledger control account balance to match the accounts receivable subledger total without investigating the underlying cause of the variance. Option D. Initiate a detailed reconciliation process, investigating each transaction difference between the receivables subledger and the general ledger, documenting all findings and adjustments. The correct answer is D. Initiate a detailed reconciliation process, investigating each transaction difference between the receivables subledger and the general ledger, documenting all findings and adjustments. Explanation. The control framework reveals a common challenge in financial reporting, the reconciliation of subledger data to the general ledger. In Oracle EBS R12, The receivables module subledger must accurately reflect transactions that are posted to the general ledger. Discrepancies can arise due to various reasons, including data entry errors, system processing issues, or incorrect configuration. The professional challenge lies in identifying the root cause of these discrepancies and implementing a robust reconciliation process to ensure data integrity and compliance with accounting principles. The correct approach involves a systematic and documented reconciliation process. This typically includes performing regular reconciliations between the receivables subledger and the general ledger, investigating any identified variances, and making necessary adjustments in a controlled manner. This aligns with best professional practices for financial control and reporting, ensuring that financial statements are accurate and reliable. It also supports auditability and compliance with internal control frameworks. An incorrect approach would be to ignore or delay the investigation of discrepancies. This failure to reconcile can lead to material misstatements in financial reports, potentially violating accounting standards and regulatory requirements for accurate financial disclosure. Another incorrect approach is to make ad hoc adjustments without proper documentation or authorization. This undermines the control environment, creates an audit trail of questionable integrity, and increases the risk of further errors. A third incorrect approach is to rely solely on automated reports without human oversight and investigation. While automation is valuable, it does not replace the need for professional judgment in analyzing variances and understanding their underlying causes. Professionals should approach such situations by first understanding the established reconciliation procedures within Oracle EBS R12. They should then meticulously follow these procedures, documenting each step of the reconciliation and investigation process. When variances are found, a structured approach to root cause analysis is essential, involving collaboration with relevant teams, e.g., accounts receivable, general ledger. Any adjustments should be made in accordance with established policies and with appropriate approvals, ensuring a clear audit trail. This systematic and controlled approach is crucial for maintaining financial integrity and meeting professional responsibilities. Question 17. Stakeholder feedback indicates that certain business units are experiencing challenges in accurately reflecting their unique operational nuances within the current general ledger and receivables structure in Oracle EBS R12, leading to requests for customized chart of account segments or entirely separate accounting setups. Which of the following approaches best addresses this feedback while ensuring the integrity and compliance of financial reporting within the Oracle EBS R12 framework? Option A. Ignore the feedback and continue with the existing standardized approach, assuming business units will adapt over time. Option B. Implement separate, non-integrated charts of accounts for each business unit to allow for maximum flexibility in capturing their specific operational details. Option C. Reinforce the importance of adhering to the standardized chart of account structure and accounting policies defined within Oracle EBS R12, and provide targeted training and support to business units on how to effectively utilize existing segments and functionalities to capture their operational nuances. Option D. Create custom accounting rules and additional segments outside the standard Oracle EBS R12 framework for each business unit that expresses a unique need. The correct answer is C. Reinforce the importance of adhering to the standardized chart of account structure and accounting policies defined within Oracle EBS R12, and provide targeted training and support to business units on how to effectively utilize existing segments and functionalities to capture their operational nuances. Explanation. Scenario analysis. This scenario presents a common challenge in financial reporting, where different business units within an organization may have varying interpretations or implementations of accounting policies. The professional challenge lies in ensuring consistency and compliance with established accounting principles and Oracle EBS R12 functionalities across all entities, especially when faced with differing stakeholder expectations or perceived local needs. The need for a unified approach is paramount to maintain the integrity of the general ledger and receivables data, which forms the basis for financial statements and regulatory filings. Correct approach analysis. The correct approach emphasizes the importance of adhering to the established chart of account structure and accounting policies defined within Oracle EBS R12. This ensures data integrity, facilitates consolidated reporting, and maintains compliance with generally accepted accounting principles, GAAP, as implemented within the Oracle framework. By leveraging the system's inherent controls and standardized configuration, the organization can achieve accurate financial reporting, streamline audit processes, and provide reliable information to all stakeholders. This approach aligns with the fundamental principles of financial accounting and the design of integrated ERP systems like Oracle EBS. Incorrect approaches analysis. Implementing separate, non-integrated charts of accounts for different business units creates significant challenges. This approach violates the principle of a unified financial system, leading to data silos, increased reconciliation efforts, and a high risk of reporting errors. It directly undermines the purpose of an integrated ERP system and makes consolidated financial reporting extremely difficult, if not impossible, without extensive manual intervention. This can lead to misstatements in financial reports, potentially violating regulatory requirements for accurate financial disclosure. Creating custom accounting rules or segments outside the standard Oracle EBS R12 framework without proper governance and integration introduces significant risks. This can lead to inconsistencies in how transactions are recorded and reported, making it difficult to enforce accounting policies uniformly. Such ad hoc solutions often bypass system controls, increasing the likelihood of errors and making the system harder to maintain and audit. This approach can result in non-compliance with internal controls and external financial reporting standards. Ignoring the feedback and continuing with disparate practices across business units is a failure of leadership and governance. It perpetuates inconsistencies, erodes data integrity, and increases the risk of financial misstatements. This approach demonstrates a lack of commitment to standardized financial processes and can lead to significant compliance issues and reputational damage. It fails to address the root cause of the stakeholder feedback and exacerbates the problem. Professional reasoning. Professionals should approach this situation by first understanding the root cause of the stakeholder feedback. This involves engaging with the business units to identify their specific concerns and perceived needs. The next step is to evaluate these needs against the established Oracle EBS R12 functionalities and accounting policies. The decision-making process should prioritize solutions that maintain data integrity, ensure compliance with accounting standards, and leverage the capabilities of the ERP system. This often involves a combination of system configuration, policy reinforcement, and targeted training. A robust change management process should be followed for any proposed modifications to ensure they are properly vetted, documented, and implemented. Question 18. Process analysis reveals that a software company has entered into a complex contract with a client that includes the delivery of software licenses, implementation services, and ongoing technical support for a period of 3 years. The contract specifies a single upfront payment. Considering the Oracle EBS R12, General Ledger and Receivables fundamentals, which approach best reflects the principles of revenue recognition for this scenario? Option A. Recognize revenue only when the full upfront payment is received from the client, regardless of service delivery. Option B. Recognize the entire upfront payment as revenue upon the signing of the contract. Option C. Recognize revenue incrementally as the software is implemented, the support services are rendered, and the licenses are made available to the client, based on the standalone selling prices of each component. Option D. Recognize the entire upfront payment as revenue when the 3-year support period concludes. The correct answer is B. Recognize the entire upfront payment as revenue upon the signing of the contract. Explanation. Scenario analysis. This scenario presents a common challenge in financial reporting, where the timing of revenue recognition can significantly impact financial statements and stakeholder perceptions. The professional challenge lies in accurately applying accounting principles to a complex transaction, ensuring compliance with Oracle EBS R12 General Ledger and Receivables functionalities, and adhering to the relevant accounting standards. Misinterpreting the nature of the contract or the performance obligations can lead to material misstatements, potentially violating accounting standards and leading to regulatory scrutiny. The need for careful judgment arises from the subjective elements in determining when control transfers and when revenue is earned. Correct approach analysis. The correct approach involves a thorough analysis of the customer contract to identify distinct performance obligations and determine the point at which control of the goods or services transfers to the customer. This aligns with the principles of revenue recognition, which generally dictate that revenue should be recognized when it is earned and realized or realizable. In Oracle EBS R12 receivables, this translates to correctly configuring revenue recognition rules, ensuring that invoices are generated and revenue is recognized only upon fulfillment of contractual obligations. This approach ensures compliance with accounting standards and provides a true and fair view of the company's financial performance. Incorrect approach is analysis, recognizing revenue solely upon the issuance of an invoice, without considering the transfer of control or fulfillment of performance obligations, is a regulatory and ethical failure. This approach can lead to premature revenue recognition, misrepresenting the company's financial health and potentially violating accounting principles that require revenue to be earned. Recognizing revenue based on the cash received from the customer, irrespective of whether the service has been rendered or goods delivered, is another significant failure. This cash basis approach is not compliant with accrual accounting principles, which are fundamental to generally accepted accounting principles, GAAP, and are the basis for Oracle EBS R12's financial modules. It distorts the timing of revenue and expenses, leading to inaccurate financial reporting. Recognizing revenue only at the end of the contract term, even if performance obligations are met incrementally throughout the term, is also an incorrect approach. This can understate revenue in periods where services are provided and goods are delivered, failing to accurately reflect the economic substance of the transaction and the company's performance over time. Professional reasoning. Professionals should adopt a systematic approach to revenue recognition. This involves 1. Understanding the specific accounting standards applicable to the industry and jurisdiction. 2. Carefully reviewing customer contracts to identify all contractual obligations. 3. Determining the point of transfer of control for each distinct performance obligation. 4. Configuring Oracle EBS R12 receivables to accurately reflect these revenue recognition events. 5. Maintaining thorough documentation to support revenue recognition decisions. 6. Regularly reviewing and updating revenue recognition policies and configurations as business practices or accounting standards evolve. Question 19. Strategic planning requires a clear understanding of how Oracle Receivables functionalities support accurate revenue recognition for service-based contracts. Given a scenario where a client has signed a multi-phase service contract, with each phase having distinct completion milestones, what is the most appropriate method within Oracle EBS R12 to ensure revenue is recognized in alignment with the completion of these service milestones, rather than solely based on invoice issuance? Option A. Defer revenue recognition until the entire contract term has concluded, irrespective of individual phase completions. Option B. Recognize revenue solely based on the cash received from the customer for the services rendered. Option C. Recognize all revenue for the contract at the time the initial invoice is generated, regardless of service phase completion. Option D. Configure revenue recognition rules in Oracle Receivables to trigger revenue recognition upon the defined completion milestones of each service phase. The correct answer is D. Configure revenue recognition rules in Oracle Receivables to trigger revenue recognition upon the defined completion milestones of each service phase. Explanation. Scenario analysis. This scenario presents a common challenge in financial reporting, where the timing of revenue recognition can significantly impact financial statements and stakeholder perceptions. The professional challenge lies in interpreting and applying the Oracle EBS R12 General Ledger and Receivables functionalities in alignment with the underlying accounting principles, specifically concerning the recognition of revenue for services rendered. Misapplication can lead to misstated financial results, potentially violating accounting standards and regulatory expectations for accurate financial disclosure. Correct approach analysis. The correct approach involves accurately reflecting the earned revenue based on the completion of service milestones as defined in the contract and supported by system configurations within Oracle Receivables. This aligns with the fundamental accounting principle of revenue recognition, which dictates that revenue should be recognized when it is earned and realized or realizable. In Oracle EBS R12, this is achieved by ensuring that revenue recognition rules are correctly set up to trigger recognition upon the fulfillment of specific events or conditions, such as service completion, rather than solely on the invoice date. This ensures that financial statements present a true and fair view of the company's performance, adhering to the principles of accrual accounting and regulatory requirements for financial reporting accuracy. Incorrect approach is analysis. One incorrect approach would be to recognize revenue solely based on the invoice date, irrespective of whether the services have been fully rendered or accepted by the customer. This violates the revenue recognition principle by recognizing revenue before it is earned, potentially overstating current period performance and misrepresenting the company's financial position. This practice can lead to regulatory scrutiny for non-compliance with accounting standards. Another incorrect approach would be to defer revenue recognition until the entire contract term has elapsed, even if significant portions of the service have been completed and accepted. This would understate current period revenue and misrepresent the company's earnings. Such a delay in recognition, when revenue is earned, can be seen as an attempt to manipulate financial results or a fundamental misunderstanding of revenue recognition principles, leading to inaccurate financial reporting. A further incorrect approach would be to recognize revenue based on cash collection, without regard to when the service was rendered. This is a cash basis of accounting, which is generally not permissible for external financial reporting under accrual accounting principles. It fails to match revenue with the expenses incurred to earn it, and does not accurately reflect the economic substance of the transactions. Professional reasoning. Professionals should adopt a systematic approach to revenue recognition. This involves thoroughly understanding the contract terms, identifying the specific performance obligations and revenue triggers, and then configuring Oracle receivables to accurately reflect these triggers. Regular review and reconciliation of revenue recognition entries against contract milestones and service completion records are crucial. In situations of ambiguity, consulting with accounting subject matter experts and ensuring compliance with relevant accounting standards and regulatory guidance is paramount. The decision-making process should prioritize accuracy, transparency, and adherence to established accounting principles and regulatory frameworks. Question 20. The assessment process reveals that a client has entered into a complex service agreement with a customer that includes an upfront setup fee, a monthly subscription fee for ongoing services, and a performance-based bonus contingent on achieving specific project milestones. The finance team is debating how to configure Oracle EBS R12 receivables and general ledger to ensure revenue is recognized in compliance with U.S. GAAP. Which approach best aligns with the principles of revenue recognition under ASC 606? Option A. Recognize the entire contract value, including the setup fee, monthly fees, and the potential bonus, upfront as soon as the contract is signed. Option B. Recognize the upfront setup fee over the contract term as the related services are provided. Recognize the monthly subscription fee as it is earned each month. And recognize the performance-based bonus only when the specific project milestones are demonstrably achieved, and the bonus is probable of not being subject to significant reversal. Option C. Recognize the upfront setup fee immediately upon receipt of payment, and recognize the monthly subscription fee and performance bonus only upon the completion of the entire contract term. Option D. Recognize revenue solely based on the invoice dates for each component of the contract, regardless of service delivery or milestone achievement. The correct answer is B. Recognize the upfront setup fee over the contract term as the related services are provided. Recognize the monthly subscription fee as it is earned each month, and recognize the performance-based bonus only when the specific project milestones are demonstrably achieved, and the bonus is probable of not being subject to significant reversal. Explanation. The assessment process reveals a common challenge in Oracle EBS R12 General Ledger and Receivables, ensuring accurate and compliant revenue recognition for complex sales agreements. This scenario is professionally challenging because misinterpreting revenue recognition rules can lead to financial misstatements, regulatory penalties, and damage to stakeholder trust. Careful judgment is required to align accounting principles with the specific terms of each contract and the capabilities of the Oracle EBS system. The correct approach represents best professional practice because it involves a thorough understanding of both the contractual obligations and the relevant accounting standards, specifically ASC 606, revenue from contracts with customers in the U.S. context, which is the assumed jurisdiction for this exam. By meticulously analyzing the contract's performance obligations, transaction price, and timing of satisfaction, and then configuring Oracle EBS accordingly, the organization ensures that revenue is recognized in the period it is earned and realized, adhering to the principles of accrual accounting and regulatory compliance. This proactive and detailed configuration minimizes the risk of errors and ensures the integrity of financial reporting. An incorrect approach that involves simply applying a standard revenue recognition template without considering the unique aspects of the contract fails to meet the requirements of ASC 606. This can lead to premature or deferred revenue recognition, violating the core principles of matching revenue with expenses and accurately reflecting the company's financial performance. Ethically, this is a failure to exercise due diligence and uphold professional accounting standards. Another incorrect approach, which is to defer revenue recognition until full payment is received, ignores the concept of earning revenue through the performance of obligations, regardless of cash receipt. This violates the accrual basis of accounting and misrepresents the company's economic activity. It also fails to comply with ASC 606 emphasis on the transfer of control of goods or services. A third incorrect approach, which is to recognize revenue solely based on the invoice date, is a simplistic and often inaccurate method. Invoices are billing documents, not necessarily indicators of revenue earned. This approach can lead to significant timing differences between revenue recognition and the actual delivery of goods or services, resulting in misstated financial results and potential noncompliance with revenue recognition standards. The professional reasoning process for similar situations should involve a systematic approach. First, thoroughly understand the contract terms and identify all distinct performance obligations. Second, determine the transaction price and how it should be allocated to each performance obligation. Third, assess when each performance obligation is satisfied, i.e., when control of the good or service is transferred to the customer. Fourth, configure Oracle EBS General Ledger and Receivables modules to accurately reflect these determinations, ensuring that revenue is recognized in the correct period. Finally, maintain clear documentation of the analysis and configuration decisions to support auditability and compliance.